Alright, so in this teaching, we are going to talk about institutional order flow signatures. And we're going to talk about specifically the fair value gap, which is one of the most used PDAs in terms of ICT concepts. Before we begin, I just want you to remind something. I just want to remind you something. I just want you to understand something before we begin. Everything we discuss is highly linked to a higher time frame bias and narrative, which is what gives us confidence in trusting these signatures. So everything that I'm going to talk about, it is going to be subjective. The first thing that you have to understand is that this is going to be subjective to a predetermined bias and narrative that we're going to have prior to looking for these signatures. That's why I also want to state that I want you to allow yourself to be less than perfect. So I'm not even perfect. I might get the bias wrong. I might get the narrative wrong. This is a time in which you will reflect upon why you were wrong. Why do you believe that you were wrong? And then you will understand that that adversity was just a stepping stone and you will actually get better by being wrong. So I want you to be patient with yourself. I want you to allow yourself to be less than perfect. And to not only look for these signatures for the signature's sake. I genuinely want to emphasize on a higher time frame bias and narrative as being the first thing, because this is what gives us confidence to genuinely look for these signatures. And exactly the same thing that I've said inside of your personal life and inside of your trading, I want you to internalize losses as business expenses. So this loss or this bias that I got wrong or everything that I've got wrong was just to highlight my adversity, the current adversity that I have to battle for me to actually get better. I also want you to understand that this is more of a psychological thing, is that I don't want you to give yourself a fixed date in which you have, and this is a big word, to get this. Because the word have implies that this is an obligation. By definition, you have, or else what? What happens if you do not have your goal on this date? And mostly, you won't have it because of the unknown unknowns. So you do not know what you do not know. And this is still viable to me as well as a mentor. I do not know what I do not know. So I don't want you to give yourself a fixed date in which you think that you're going to get this. I want you to have an open time period in which you are going to be able to do this. And I want you to understand that it takes time to genuinely internalize these completely. So you might be doing the correct thing right now, but the only thing that is off is timing. So I want you to understand that it takes time to internalize these completely. You will do all of the work, yet it will feel like nothing is genuinely happening. And in reality, you just have to pay with time. You just have to spend time and attention, and you'll eventually see that these things are going to be seen inside of your live trading, inside of your life looking at the markets, tape reading, whatever. I also want you, inside of that, understanding that it takes time to internalize this, and you do not have to have a fixed date for this. I want you, therefore, to take this slowly and surely, because we are choosing compounding. We're choosing to do the same thing over and over again, over quick and sudden dopamine hits. For example, you might say that, oh, I can do 90 to 120 minutes of backtesting every single day, 4 times a day, straight from the beginning, straight cold turkey. This is not the correct approach. You will start with 15 minutes, then you go to 20 to 30. Once you're comfortable with 30, you're going to go to 60. Once you're comfortable with 60, you're going to go to 90. So, with all of these said, let's just get into the lesson. So, the fair value gap. By definition, and I know that you know this, but by definition, the fair value gap And let me just stop for 1 second to clarify why I tell you this. I tell you this because I promised to you that I'm going to give you an absolute, the logic of everything that we're going to talk about. I promised you that I'm going to give you the logic so you can absolutely become independent. So it is crucial that I define these things so you can, on your own, so you can understand them on your own. So you can understand the logic behind the fair value gap. To understand the logic not below, but under the order block or off the order block. So, a fair value gap, by definition, is an inefficiency formed in a three candlestick formation where the market delivered into one side of the market, leaving an imbalance. And this is going to be more emphasized when we understand the real reason why we name a buy side imbalance sell side inefficiency, a buy side imbalance sell side inefficiency, and a sell side imbalance buy side inefficiency, a sell side imbalance buy side inefficiency. So, the types of fair value gaps are as follows: a buy side imbalance sell side inefficiency, where the market has delivered buy side delivery in an imbalanced manner and is inefficient in sell side delivery. And a sell side imbalance buy side inefficiency is where the market has delivered sell side delivery in an imbalanced manner and is inefficient in sell side. And I meant to write buy side really. So it is inefficient in buy side delivery. So again, I allow myself to be less than perfect even with this presentation because I've had to do it because this is prior to the AM session, but I'm not going to rush the teaching. I'm just did not observe this one because I did not have any time to reflect upon this PDF. Therefore, a BISI needs sell side delivery, which is the market going lower, to be rebalanced, which is a big word when it comes to rebalancing, and you're going to understand what I mean by this. But a BISI, a buy side imbalance, sell side inefficiency, it means that it is imbalanced in buy side, and it requires sell side to be made efficient. So this means that we need sell side delivery, and sell side delivery is just the market going lower. So the market has been delivered imbalanced to the upside, and it needs sell side inefficiency to be made rebalanced. And same thing goes for the bearish fair value gap, which is a CB, which needs buy side delivery, which again is the market going higher to be rebalanced. The differences between fair value gaps and the understanding of when they're made efficient and when they're made balanced, because these things, they are two different things. So, the fair value gap is made efficient when the market trades back into it. But the fair value gap is going to be made balanced when the market trades away from it, leaving therefore a balanced price range, in which we know that the market should not come back into it until the objective is successfully reached. So, this means that when the market, for example, in a bullish scenario, when the market trades back into a fair value gap, and when the market trades back into a BISI, what we anticipate is for the market to rebalance this imbalance if we have an objective higher. So if we have a level of buy side that we're aiming for and we did not reach it yet, then when the market comes back into the fair value gap, that is made efficient. But that is not balanced yet. For the market to rebalance that imbalance, the market has to leave it. So this will become a balanced price range in which we know that the market should not come back into it until the objective is successfully reached. And I want you to correlate this with the knowledge of the intermediate term lows and highs. And this is why an intermediate term low and an intermediate term high is never meant to be passed. And if it is, then we reverse or stay sidelined. So this is why an intermediate term low is so important when it comes to the market. And this is why we never want to see that low being taken. This is why we never want to see that low being taken, that swing low being taken, that was formed inside of a fair value gap, because the market has successfully fulfilled the purpose of rebalancing that imbalance. But once we leave it, that is a balanced price range. That is the fair value gap being rebalanced. But the market first has to create a swing low. So that is the intermediate term low. That is why it never has to be breached until we indeed reach our target. And this is an example of the fair value gap, and I'm going to show you the differences between the efficient fair value gap and the balanced fair value gap. So this is an S&P chart. This is the daily chart. This happened in June, and I've used this example to, I don't know why I chose the S&P really over the Nasdaq, mainly because I've had more annotations in the Nasdaq rather than the ES. But what I want you to understand, and this is a daily chart, is that when the market came back to this fair value gap, knowing that we were aiming for something higher than this fair value gap and even higher than this level of buy side, or even if you were aiming for this level of buy side, then once the market came back into this fair value gap and took out this low, then we see this movement going back to the fair value gap as a means of what? As a means of the market making it efficient. But once we leave it and the market creates a swing low here, then this candlestick should do what? Well, by this swing low creation, then we know that the market should not go below this one because it is already made efficient. What does the market do? Well, this is the fourth candlestick of a swing low. So this is the swing low, this is the swing low formation, so this should not go below this one. So what would my daily bias be here? And how low would I want to see price go? Well, I do not want to see the price go below this low or this low. Otherwise, this will be invalidated because this fair value gap is now made balanced because we left it, we created a swing low, and this is an intermediate term low. So this means that we are now inside of what? This means that the market has retraced, it made the intermediate term low, it rebalanced this imbalance. So this means that we're now inside of the expansion. And we know, based on the other teaching that I've taught you with the retracement, expansion, that the market has successfully fulfilled the retracement, and now we're inside of an expansion, which correlates with the order block, which correlates with the concept of the order block. So you can see how beautifully this correlates. And then we have the market leaving this here. So now, after the market has successfully traded above this one, now I never want to see the market, if I have a target over here, if I have a target to the upside, I never want to see the market go below this low and this whole entire dealing range. The market has no reason to retrace back deep into this. The market has no reason to retrace back into a discount to this range because we have already done the damage, or we have already fulfilled our purpose to rebalance this imbalance. Because all of this retracement, its purpose was solely to retrace back into the fair value gap. Now, this fair value gap therefore is justified for a little retracement, but overall we're inside of an expanding market. And what I want you to see is that, again, the market forms a swing low. The market comes back into the fair value gap. Right here at this point, the market is made efficient. We created a swing low. And now the market did what? The market never went below this. And therefore, after the market trades above this short-term high, this becomes a balanced price range. So the market should never go back below it. And we're also inside of an expansional move. So this order block is used to send price higher. So when the market comes back into a fair value gap, this is when it's made efficient. When the market leaves, this is when it is made balanced. So the market does not have to go below this low, and this is the logic of intermediate term lows. The sensitive points of a fair value gap are as follows. And this is for bearish or bullish fair value gaps. It does not matter. So it is the fair value gap low, the fair value gap 25%, which is the lower quadrant, the fair value gap 50%, which is the consequent encroachment, or CE, the 75%, which is the upper quadrant, and the fair value gap high. These are all the sensitive price points you should really care about. And as you can see here, the market uses both the consequent encroachment and the upper 75%, or the upper quadrant. And the way I saw the levels, where I put a fib from this high, the fair value gap high, to the fair value gap low. I mean, from this candlestick's high to the fair value gap low to this candlestick's low. This candlestick's low forms the high of the fair value gap. This candlestick's high forms the low of the fair value gap. 50% would be here, which is the consequent encroachment. 75% would be here, which is the 75% level between this and this. And the lower quadrant is here. Now, the fact that this was left open, this is going to form and is going to give us a sign of strength. And this is the example that I showed you prior. This is just zoomed in. But these are the sensitive levels of a BISI or a SIBI. It does not matter. So when we're going to look at the market with a bullish perspective, we want to see the market only go, for a sign of strength, the market we want to see the market go into the 75% or the 50%. We allow for the market to go into the fair value gap low. We prefer not to see it instead of a bullish bias, because that would give us strength, but we allow for it. So if the market reached back into this here, in this case, in this specific case, I do not believe that the market would have reached back into this, because I've explained the narrative beforehand with you. But this here, if the market would have came back into it and it closed right at the fair value gap low, then this would be a correct usage of the fair value gap. The inversion fair value gap. And I'm just going to give you a bullish scenario. This is also applying, or this also applies to the bearish scenario. But in a bullish scenario, when you anticipate the market to go higher, if the market closes above a SIBI, then this PDRA fails and is used as a means of support. And if we have a higher time for fair value gap, which is the weekly and daily, and we are looking at it through the lens of a 15-minute or less, then a closure above the SIBI 25% makes us understand that the market will run for the 50%. And the same goes for the 50% and 75%. So if the market closes above the 50%, which is the consequent encroachment, then we understand that the market has to go for the 75%. And if the market closes above the 75%, then the market should go into the fair value gap high, and so on and so forth. The breakaway gap. And I'm going to give you a visual example of all of these at the end of the lesson. But the breakaway gap, as a definition, is a fair value gap that is left partially unfilled or completely unfilled, signaling a sign of strength or weakness inside of an already predetermined bias, higher and lower. So this is the most important thing when we're looking at the market, the predetermined bias, higher or lower, which is absolutely going to give us the confidence to understand whether this fair value gap is going to be closed below, meaning that we're going to look for a bearish scenario, so I'm looking for this fair value gap to fail, or if this fair value gap is going to be used as a bullish fair value gap and is going to be a breakaway gap, then if the market genuinely makes the breakaway gap, then I know that this is a sign of strength. It is all determined by the predetermined bias. So my perspective on the market will tell me if a fair value gap, if it's left inefficient or if it's left open, this will tell me, the bias will tell me that whether I use this as a means of sign of strength, or I want to see the market close below its low and use it as a means of resistance. And I'm going to explain this inside of the chart. The breakaway gap is usually forming after the market is done with the retracement, rebalanced another imbalance, and is ready to expand, or is ready to begin an expansional movement. So when the market has successfully created an intermediate term low, then the market wants to move away with speed, if we are indeed correct inside of our bias. So this will do what? This will give us signs of strength or signs of weakness in a bearish scenario. So this is why it correlates with the propulsion block, as the order block is correlated with expansion. So I can already see how these lectures, they combine and they are reliant with one another. So in the example that I showed you prior, when the market was retracing and the market finished the retracement by rebalancing that imbalance and we formed the swing low, then we saw a breakaway gap. Then we saw a completely unfilled breakaway gap. And the last one, and this is one of the least fair value gaps that I used inside of my trading. But this measuring gap is a fair value gap that is situated at the 50% of the implied dealing range and is used for standard deviations, and also represents a sign of strength. And also I want you to understand that the measuring gap is a form of a breakaway gap, which means that it has to be left unfilled, either complete or partially. And what a measuring gap really is, it is formed by understanding what the implied dealing range is. And the implied dealing range is from the low or high that is for the current dealing range where you entered to the unrealized, and that is why it's an implied target. So when we're talking about an implied dealing range, and I'm going to give you an example of this. The implied dealing range is from the swing low that has been formed from the intermediate sum low that you know that the market does not have to take to the target that you're aiming for. So I'm going to show an example of this, but the most important thing that you have to realize about implied dealing ranges is that these are implied. These are unrealized. So the market did not deliver to the target. But when the market goes into the 50% of this implied dealing range, then we're going to anticipate a fair value gap forming, and we're going to anticipate that fair value gap to be left open, and that would frame us a measuring gap, and this will give us a measuring when it comes to applying dealing ranges and applying standard deviations. That's what I meant to say, standard deviations. And this is a beautiful example inside of the Nasdaq. This is almost the absolute same. This is the same dealing range, but only seen inside of the Nasdaq. You can see beautifully how the market came back into the fair value gap. We had a swing low formation here. The market left this one, so this now becomes a balanced price range. Then the market left, and therefore the market should not go below this because it completely fulfilled its purpose, and we also ran the level of sell side inside of the daily chart. So my implied dealing range would be as follows. I do not have it here, but I have it here. It's the 1. But basically my implied dealing range would be from this dealing range low, the intermediate sum low that has been used to frame this balanced price range or this balanced fair value gap, to this unrealized target. So when we're going to look at the market here or here, imagine we're trading inside of this candlestick. And I do not know if you recognize, but this is the exact example that I've used inside of the video that I've sent to you in the past days, or inside of the video I have on my YouTube when it says, I believe, how I predicted the whole entire 1 minute candlesticks, and where I said that the market created the low of the week on Tuesday. This was Tuesday's trading, and then we wanted to see the market go higher. This is May 2024 trading, and I have a video on my YouTube channel in which I explain this movement in depth. But this is a fair value gap because from this low, a measuring gap, because from this low to this unrealized target, if you're going to look at this candlestick, this is going to be the measuring gap because it is also left unfilled and is situated at the 50% of the implied dealing range. So this here never happened, but we anticipate it to happen. And if this is left inefficient, then this is going to be a measuring gap. And this measuring gap, if you're looking at this from the low to the high of the measuring gap, then you will understand that the -1 standard deviation is exactly correlated with the high, perfectly projecting to the high of the to the high of this unrealized target, and the -0.5 is the 75% of this implied dealing range, exactly to the point. And this is a daily chart, so this is massive. And for the last example, this is an example. It is the same example, but this is a breakaway gap. And of course, I told you that the measuring gap is just a form of a breakaway gap. So this is a breakaway gap. The market came back to the fair value gap. It made it efficient. Then we left it. This now becomes a balanced price range or a balanced fair value gap. Then the market went above the short-term high. We were aiming for these targets. This is the buyer's narrative. We're aiming for this. The narrative is that we never want to see the price go here and inside of this dealing range. So this whole entire dealing range is balanced because we have successfully created the retracement. This is the fair value gap that we never want to see the market go into, and this is completely left unfilled. And this is an inversion fair value gap. But I would already anticipate the market to close above this inversion fair value gap and use it as a means of support because I already know that the market has to go here because of my higher time frame bias narrative, because of my higher time frame weekly narrative. And this because the market closed above the 50%, and we never want to go deeper into this. We know therefore that the market will, or the market failed at the 50% here, and we also have a volume balance opening. This is one signature that I've studied on my own. It is not important. The important thing that you have to realize is that the market closed about the 50%, and we already know that this is going to be a breakaway gap. So the market opened, it used the 50% of this inversion gap, and then it successfully closed above it, and we never came back into it. This is another sign of strength. And you can also see here inside of this beautiful fair value gap, the market creating a swing low. The market came back to the fair value gap, made it efficient, swing low, taking our short-term high. Therefore, this is an intermediate term low, and this is balanced. You can see how Tuesday's trading, or this day's trading, went only back to the order block, which is a beautiful concept, proof of the expansion, that the market goes back to the order block, and it never wanted to see this again because this is made balanced, and we just attacked these highs. And this is a beautiful explanation of the breakaway gap, the fair value gap, and the inversion fair value gap. This was the presentation. I hope you truthfully enjoyed this one. I hope you genuinely understand by now the logic of fair value gaps, how this correlates to the market structure, and how it correlates to absolutely everything. And if you have any questions, don't forget to DM me on my Telegram, which is StoianAlin with double N. And I hope you enjoyed this one.